All right, I want to thank you for joining me today for the latest in my Ask Me Anything series of webinars, 7 important money conversations you can have with your spouse. Anyway, I hope that everybody's doing well today, and I hope you all had a happy Thanksgiving. I know that the circumstances were different this year, but hopefully you still got to spend some time with those that are closest to you for the holiday.
There you go.
So I'm going to talk about, like I said, the 7 most important money conversations you should have with your spouse. This is a list of what those questions are, and I'm going to go through them in more detail. So the first one is really understanding where you are today. So do you know how much you've saved, what your income is, how much you owe, what you spend? Do you have any pension income available or anything like that? All those questions are really important in determining what retirement is going to look like and what you want it to look like. A lot of couples, they don't equally understand their situation. Some might understand a little bit of it, some might understand all of it, and it's not always equal between the spouses. In my background, I'm a CPA, so if I think of this from an accounting perspective, then I think about what's your net worth as part of this, what are your assets, your liabilities, your income and expenses, or what's your balance sheet and your income statement and your cash flow statement look like from a personal perspective. That's kind of the beginning. It's just trying to understand where you are right now. Then we want to know, when would you like to retire? Is that date of retirement, is it within the next few years, or is it much further out? Because that determines how much more time we have to save and prepare for retirement. And also it's important to note that our plans can change. If you're in that 10 to 15 years or more than 15-year category in particular, lots of things can change. Like when I work on a financial plan with a client, I tell them that the financial plan kind of says, here's where we sit today. And we're trying to get from point A. In my process, I call pathway to an informed retirement. So we start out where we don't know a lot about what retirement might look like. And we're trying to get to point B, which is where we're more informed. But I tell them that, on a piece of paper, that's a straight line from A to B. But in real life, it's not a straight line at all. There's lots of ups and downs and everything else along the way. And things may change too as we go. So we want to make sure that we acknowledge that, we update the plan as time goes on. Next question is, what activity is most important to you in retirement? Do you want to focus on spending time with or supporting your family, your children, your grandchildren? When it comes to your family, do you want to live relatively nearby, or do you want to have to travel every time you go see them? Do you want to be able to take care of your grandkids if you have those? It's more important that you spend time with your friends and be where they are. What kind of recreational activities do you want to do? And do those involve being inside, outside? Do you want to travel? And you have to think about all those things if that influences where you live as well as what it's going to cost. Then the next question is, which word most accurately describes your vision of retirement? You're looking for fun? Do you think it's going to be a life of leisure? Do you think you're going to be bored? If you're going to be bored, then you might want to think a little bit more about what you're going to do, or that's why some people end up working a lot longer than others. Also think about, do you envision your life in retirement? Will that be different than your pre-retirement years? For example, when I talk to clients, some people tell me that they were really frugal during their working years, and they plan to enjoy life more in retirement. I'll tell you what we often find is that those habits can be hard to break. So we expect that transition to happen when we get into retirement, but we don't always get it. But your answer to this question above about which word most accurately describes your vision of retirement, that's going to help shape some of your answers to the questions that follow as well. Next, probably one of the most important ones. Where would you like to live in retirement? From a broad perspective, that means, do you want to stay where you are? Do you want to stay where you are but downsize? Or do you want to relocate? And when you're thinking about about where you want to live, here's some of the important factors to consider. Do you want to live in a house? Do you want to live in a condominium? Live in a condominium, that means you don't have to worry about a lot of the maintenance and upkeep the same way you do if you own a house. What are the housing costs where you want to live? What kind of community is there? Lots of places there's retirement communities, senior communities, there's 55 and older communities. Do you want to be part of something like that? And what other things are going on in the community that you live in? Or maybe you want to be near people that are of a similar religion or some other type of belief that you have. Or what kind of healthcare is available? What's the climate? What's the taxes? And taxes, I mean, I'm primarily referring to state taxes. And that's why a lot of people end up in Florida, because Florida is one of the states that have warm weather. So you have the climate if you like warm weather and you don't want to be in the cold. And then there's no state tax. So that's one of the reasons that a lot of people favor Florida for factors like that. And if you want to be outside and golf and things like that, it also favors a location like that as well. But other people want to be in different places too. What are the available activities, right? Is it well suited to the things that you like to do? And also, what's the cost of living? And there's lots of different things that you can look at, and you can search for a lot of this information on the internet. In the blog that I'm going to publish tomorrow, I found a good article from Money Magazine talking about the 10 top places to retire to, at least based upon their research. Because you can see those studies from lots of different perspectives, and you can get lots of different answers, but they seem to do a pretty good job, and I thought it was worth sharing that. So you'll see that when you get my blog tomorrow. Then, from a more broad perspective, you have to start thinking about, are you comfortable with investing and its tax implications? And what do I mean by that? Well, when we're working, it's a lot different than when we stop. When we're working, we're really focusing on accumulating assets. But when we stop working, now we start to worry about decumulating assets. And that means that there's different tax implications. And a lot of people expect that their income in retirement is going to be lower than it was when they were working. But if you've been a diligent saver, when you get to 72 and you have to start taking money out of your IRAs and your 401ks, your income might actually go up. It depends on how much is saved. You have to think about the different account types, because each one of those account types can be treated differently from a tax perspective. We have our brokerage accounts where the money goes into the account, it's after tax. Any dividends and interest that money earns is taxed currently. And then you pay capital gains tax, which is at a lower rate on the sale. Then you have your 401k, your IRA, your 403b, those type of retirement accounts. And for those accounts, we get a tax break on the money that goes into the account. We don't pay any tax while the money is in the account and while it grows. But then when we pull it out, we pay tax at our ordinary tax rates. Then we have Roth IRAs. And so a Roth IRA, we pay tax on the money that goes into the account, but we don't pay tax on the money as it grows, and we don't pay tax on the money as it comes out of the account. And so that difference there, not paying tax when we pull the money out versus paying tax when we pull the money out, that can mean that we might want to think about things like Roth conversions. And that's why I talk about bracket stuffing. And what I mean by that is if you look at the income tax tables, you'll see that there's different tax rates based upon what your income is. And you might want to say, well, what's the rate that I'm most comfortable paying now? And you might fill that bracket up. Like maybe it's the 22 or the 24% bracket. Because right now, for married couples, we have a 22%, we have a 24% bracket, then we go up to 32. So you might say, I want to fill the 22 or the 24, do some Roth conversions, something like that to accelerate some income today, because I think that rates are going to go up in the future, or my income tells me that even if rates didn't go up through the change in the administration that we're going to see in January or something like that, that I still think my rate's going to be higher. And you also have to think about the fact that whether we like it or not, one spouse typically outlives the other. And when that happens, the remaining spouse is now filing single instead of married. And that also means that your tax rate can go up. And what normally happens is the assets pass from one spouse to the other. Then they go to somebody else, like the children or the charity or whatever your inclination may be. And so that income is going to be the same amount of income, but there's only going to be one person. So that can make your tax rate go up. And like I mentioned, so we want to think about withdrawal strategies. So I have a link here to a blog that I published where I talked about withdrawal strategies. And a lot of people think like the conventional belief, I think, is that you kind of let that Roth money stay to last. But what I'm saying is if I look at tax rates, maybe there's opportunities to do some other things. And I might want to take a blend and not just focus on draining one account first or another account after that. You also have to think about what happens when you do pass, the assets that pass to your heirs are also taxed differently, right? If under current law, if you pass securities to your heirs, they get a step up in basis, which means that I have a client, for example, that has a basis in Apple stock of 14 cents a share because it was, what, 3 days after the IPO. Well, that means that the entire, basically, if they sold any shares, the entire purchase price is going to be subject to, sales price is going to be subject to capital gains. But if those assets pass at death, then they're stepped up to fair market value, and then there's no gain if you were to dispose of them right after that. So that's something you have to think about. And then, where do you expect your retirement income to come from? Social Security, that's where most people start. For some people, honestly, that's where they finish. But you have to think about it's not just knowing that they're expecting to have some Social Security, and I know there's talk about whether or not those benefits could be cut or what could happen. And right now, we still think that you're going to get something. I can't say that it's going to be the full amount, but there could be changes. There's been changes talked about by the Biden administration before the election that would get rid of at least part of the cutoff on Social Security taxes you get at a certain level of income, and it would raise that. You would get nothing from the current cap, which is around 150,000, up to 400, and then you would start paying tax again after that. But the other question about Social Security is, when should you start claiming benefits? For most people, if you're born in 1960 or later, your full retirement age is 67. If you're born before that, it's going to be something a little bit less. I think it's 1953 and earlier, it's 66, and then it goes up a little bit each year till it hits 1960, and then it becomes 67. And there's different treatment of your benefits depending on when you start. And if you can wait till 70, which is the latest date that you can wait to start claiming, your benefit grows at 8% per year. And in any environment, that's a tough return to beat. So if you have other ways that you can make up for whatever income Social Security would have given you, it can be worth it to wait till age 70. Then you have to think about, where are your savings? As I mentioned, what are the accounts that they're in? Are they in taxable accounts? Are they in tax deferred accounts? Are they in tax-free accounts? What types of income are you going to get? From a portfolio and from your retirement savings, you're primarily going to get interest, dividends, and capital gains. I didn't put them here, but if you have annuities, that would be another source of income that you could have. Annuities are generally something that I shy away from because there's a lot of costs with annuities. So you have to be very careful with those. And then other sources of income, for some people that want to continue working, so there's some part-time work. Some folks are eligible for pension in today's world. That's less common. Typically, the people that get pension today are either high-level executives or government employees. Those are the primary pension earners today, and teachers. I guess that would be the third category. And then the last thing is, some people count on an inheritance to help them get through retirement. So I've went over a number of different things. So how do you prioritize? There's so many choices, especially when we think about what it is that we want to do. So when I work on somebody with a financial plan, I tell them, let's think about everything we could possibly do. Doesn't mean we can do it, but let's get everything in there. And then we go through a series of life planning questions. And the focus of those questions is to help me and you determine what the priorities should be and what we should focus on, so that we can say, okay, well, these are the things we really need to do or really must do. But then after that, here's the nice to have, and here's the, well, if things in the perfect world, we do all these, but maybe we can't. So we want to be able to prioritize them and look, or maybe we have to say, well, some of these things that we want to do a little bit less. Like we say, well, we want to take a vacation. Well, we can take a vacation, but instead of spending $5,000 a year, maybe we have to spend $2,000, or instead of spending 10, we have to spend 5, or whatever it is. But those life planning questions help with the prioritization, and then the plan itself also helps you figure out what you can and can't do. I did have somebody that's on this call sent me a number of questions, and I thought that I would go over those, and then I'll open the call up for questions and any other questions that you have. The first question is, when couples discuss finances, is transparency necessary? What about disposable or no guilt money for each? In my opinion, there should be transparency. I will tell you that I have talked to people where the husband and wife, they don't know what each other's making. All right. It's just like when I do a financial plan, I want to know everything, because if I know everything, that gives me the best chance to give you a good answer and not have as many surprises. So I think it's important to be transparent, but that doesn't mean that you can't have a certain amount of money that's that disposable or no guilt money, where you say, we're going to take and I'm just picking a number, $100 a month, and that's going to be my no guilt money, or 200, or it depends on what your income is, what number that might be. But there's nothing wrong with doing that, but that has to be included in your budget so that you're not counting on that money for something else. Should couples have separate bank accounts? His, hers, theirs, earmark bills for each? Again, that's a matter of personal choice, right? And so one area, though, that I think it's really important that it is separate is if there's an inheritance, because under the law of most states, if you have an inheritance, that's yours. Even if you're married, that remains your asset. So it is important in that case to put that money and account for it separately so that that spouse who got that inheritance, it's their money. It doesn't mean that they can't use it for the couple, but it's theirs first. And you should let that, that integrity of that money be kept the way that it is. But then beyond that, having separate bank accounts, again, I think that's a matter of personal choice. In terms of the next question is who pays what bills and who wants to pay the bills? I think it's easier if one person pays the bills. What we do in my house to get a little bit of division of responsibility and make sure that both of us know what's going on is, we pay for a lot of things by credit. And I think with COVID, everybody's paying for things by credit if you can, because that's what the stores prefer. They don't really want cash because they're worried about COVID-related disease transmission or germ transmission. So what we do is we take our receipts, the credit card bills come, my wife, Diana, takes those bills and those receipts and she matches them to the statement. And then I enter them into Quicken where I keep track of our finances and I pay the bills. So that way we both know what money is being, how the money is being spent and what it's being spent on. So there's a little bit of division of responsibility there. Then the next question, what type of insurance needs should be considered or funded? There's a lot of different types of insurance. I mean, I recommend term over whole life or any other exotic life insurance product. The term that the phrase that I like to use that I've heard many times before is buy term and invest the rest, because what happens is when you get any of the more exotic insurance products, you're combining insurance with your savings, and the fees that you pay are a lot higher. If you get term insurance, it's a lot cheaper. And then as long as you have discipline, you can save the rest. And when you do, when you fund that, you want to think about income replacement. You want to think about paying off debts. You want to think about child care expenses, and you want to think about college expenses. And you can also do things like laddering insurance policies. And what I mean by that is saying, well, my kids are 10 years old, in 15 years, they're going to be finished. They should be finished college. So maybe I need more of an insurance policy to cover me for 15 years. And then I want to still have something beyond that. So maybe I get like a 15-year policy for one amount. And then I have a 25-year policy or a 20 or a 30-year policy, whatever the case may be, that gives me an additional amount that goes beyond that. That reduces your costs and still gives you the coverage that you need. But the reason to do that is once the kids are finished with school, you don't really need as much insurance most likely. So that's a way to reduce the costs and still provide adequate insurance. But it's not just those type of insurance. You also have to think about things like long-term care insurance, if you want it, auto insurance, how much do you need, homeowners insurance, umbrella insurance, especially if you have kids, and even more so if they start driving. Umbrella insurance is really relevant because it helps take your liability limits and extend them, and it's usually pretty cheap to get. Just want to be careful. You don't want to over-insure because that can be costly. It's money that you don't need to spend. And then what should you be saving and budgeting for? Like, one of the things I like to think about is pay yourself first. And what I mean by that is, if you can, it's easy if you have like a work 401k or 403b or something like that. Make sure that you contribute to that account, at least get your employer match. But that comes out first. So then you're not really missing the money, so to speak, because you never had it. But you want to think about an emergency fund, and typically an emergency fund is recommended at 3 to 6 months of expenses. But how much it is and which side of that spectrum you're on is really dependent upon the stability of your jobs and your income. You want to think about having ways to pay for vacation, childcare, and all your different household expenses. And there's really two categories of household expenses. We have the fixed expenses, which are things like your mortgage, where that amount doesn't change. And then there's the variable expenses. You can adjust what you spend on food. To a certain extent, you can adjust your utilities because you can make it a little bit You cannot turn the crank the air conditioning up quite as much in the summer or the heat quite as much in the winter, but most of that's going to be a fixed cost. And if you have credit cards, you want to think about always trying to be able to pay that balance in full and not pay those really high interest rates. And then also make sure that you have some money for savings and investments. So that's it for the prepared part of my presentation. And I'm happy to, I'm going to unmute everybody, and I'm happy to take any questions that you have at this point.
Phil, how do you introduce someone who hasn't really been in the stock market or has an aversion or is a little concerned? My wife is raising her hand about losing money. How would you recommend making an introduction to investing in the stock market?
So, I guess a couple things, Ron. I mean, I want it to be slow. I want to make sure that I take the time to explain, and so that they understand what they're doing. I want to make sure that I take a more diversified approach. So, like I go through risk tolerance with people to try and understand what I'm doing, especially when I'm doing a financial plan, to try to understand what allocation might make sense for them. Because I tell people, and I've spoken on behavioral investing on a number of occasions, and that's really how our emotions connect with or can hurt our investing. And kind of the two worst things that we can do as investors is we can buy high and we can sell low. And so it's important to have a process in place and an asset allocation in place that we're comfortable with, so that when the market does have its dramatic moves up or down, we're not as prone to overreaction, because that's really what our emotion does, right? When the market goes down too much, we get very fearful and we want to sell. And when the market goes up, we can get greedy and want to just keep buying more. So it's important to have a process in place. But when somebody's starting out, I think it's important to take the time to explain, so to start with something that's kind of conservative. So like the research that I've seen says, from an asset allocation perspective, if you are 20% stocks and 80% cash or fixed income, that anything less than 20% in cash doesn't really provide any more safety than being 20-80. So you might start there and get comfortable, and over time you may be able to change that. Maybe you can, because your age factors in as well, right? As we get older, we tend to be a little bit more conservative, though. If you're worried about outliving your money, you do want to be careful about getting too conservative. I mean, I think it's really, sorry for the long-winded answer, but I think it's really about gaining some knowledge and taking things slowly. Like, if we want to build to, let's say the goal was to build to a 30% stocks and 70% cash and fixed income. Let's put a time frame on that, so we don't do it all at once. Because the other concern that I would have is that if we do it all at once and then the market does fall right after we do it, if we did that whole 30% all at once, then now that fear is going to really set in even more deeply. So we want to do it in pieces, so that if that happens along the way, then we still have opportunities to make up for it by buying at a cheaper price at a later date.
I'm sorry, is it 30% cash and 70% fixed income?
No, that was 30%. In the example I just gave, it was 30% stocks and 70% would be the cash or fixed income.
I see, okay.
Anybody else have any other questions?
No.
Phil?
Yes.
I have another one.
Okay.
Are you a fan of buying individual stocks or mutual funds, or a mix of both?
So it depends on the individual. I mean, I have people where I do work for them that all they have is individual stocks. I have other people where they have a mixture. And I have some that I don't really use mutual funds. I generally, there's a couple that I use, but typically I use exchange traded funds instead of mutual funds. And the reason I do that is they're a little bit easier to transact in, because they trade during the day like stocks do, and mutual funds only trade at the close. And then the other reason is because if they're in a taxable portfolio, ETFs generally don't throw off capital gains distributions, and mutual funds do, so you can get a big tax hit at the end of the year. So for a beginning investor, I think that ETF makes a lot more sense because it's more diversified, and diversification is a really important thing. The other thing too, to go back to the original question, Ron, is that, if we just keep our money in cash, we're losing money, right? Because today interest rates are next to zero. I think if I go to an online bank, the last time I looked, I could get about 0.75%. There's costs that you have for things that you buy that are going up. So relative to that inflation, your money is losing value by sitting in cash. So that's another reason you have to take at least some chances, right? You're willing to assume a little bit of risk, because otherwise you're losing money by just holding your money in cash. So investing is really important.
Great, thank you.
You're welcome. Anybody else have any other questions?
Well, if you pay me more, I'll ask another question.
Go for it.
The asset allocation you discussed over is that 30% in the stock market and 70% in fixed income. Mm-hmm. That's going to vary, of course, I'd imagine, based on age. Is that right?
Age is a factor. How do you react when the market goes up and down? I mean, if I look at my clients, I think the most aggressive portfolio one of my clients has is 80% stocks and 20% fixed income. On the other end, I think the most conservative is 40% stocks and 60%. So it's dependent upon age. It's dependent upon your willingness to assume risk. Those are important factors. Also, let's look at your financial plan and see what's necessary, because I might look at a plan and your risk tolerance says that you could be 80-20, but your plan says you don't really need that. So maybe we want to think about, let's dial it back, because to me, it's really not about beating the market. It's really about being able to live and have the quality of life in retirement that you desire. And why should I take on more risk if that risk jeopardizes my chance of having that quality in life and retirement that I'm looking for?
Right, that makes sense. Where do you recommend buying term insurance?
So if you're buying term insurance, I have a couple of firms that work with fee-only advisors like me. And typically I give people 3 names and suggest that you get quotes. And then I'm happy to work with you after that to pick the one that makes them pick what's best for you. And because you want to think about the financial, I think it's the best rating is best is the one that rates the financial health of insurance companies. You want to make sure that they have a good rating in terms of their financial health. And you want to look at what the fee structure is, because the last thing you want to do is you start paying for insurance, and then when you need it, the insurance company's gone belly up.
Right.
But if you're interested in something like that, let me know and I can give you some referrals.
Yes, please.
Okay, I will send that to you when we're done.
Great.
And the other thing too that comes into that allocation is, what's your time horizon? Right, that's the one I left out. Like, how long are you investing for? If it's money that you need for 20 years or more, being in stocks is generally fine, because over 20 years, there hasn't been a 20-year span that I've seen any data for where stocks have not provided the best return. So you do want to your time horizon matters. Anybody else have any other questions?
Not from me. Thank you.
You're very welcome.
Phil, thank you very much. It's always a pleasure to hear your advice.
Thanks, Ron. I appreciate you joining.
Thank you, Phil.
You're welcome, Susan.
That's Annie.
I'm sorry, Annie. Thank
That's
you. You know,
okay.
I looked at what it said on my screen. Sorry about that. Thank you, Annie.
And we'll make an appointment to get together again soon.
Okay, great.
Alrighty. Thanks.
Thank you. All right. If there's no other questions, I want to thank everybody for joining me, and I hope you enjoy the holiday season. And I will be back again in 2 weeks with my next one on the 17th, and that'll be 5 o'clock on the 17th, but I'll send you information on that as the date gets closer. Thanks, everybody. Have a great day.
Wonderful. Thank you. You too, Phil. Bye-bye.
Thanks. Bye.